Welcome back to the John Author's Note. Today we're going to ask the question, is the commodities supercycle over? It's something that's been exercising the minds of emerging market investors who are looking to see which countries are most vulnerable to a slowdown in a fall off in their revenues. And here today to talk about it with us is David Rees, emerging markets economist at Capital Economics in London. David, thank you very much for joining us.
No problem.
We've got a couple of charts to look at. The first shows us the S&P GSCI commodity price index over the past few years. It's a very broad commodity price index, takes in most commodities but heavily weighted towards energy. We see some volatile activity over the past year or so, and then your prediction down quite sharply next year. About how big is that fall and why is it happening?
Sure, the fall's about 15 to 20% for most commodity prices. Our view is that recently two things have been supporting commodity prices. The first is speculation that stimulus measures are going to boost global growth and therefore demand for commodities. And secondly, that unrest in the Middle East is going to create supply problems in the oil industry.
Right.
We view both of these issues as being temporary and therefore are forecasting oil prices and other commodities to fall next year.
Right, okay. Now we can see on the next chart what the impact on that is on. This is the impact in terms of a percentage of GDP on government revenues. Now, unsurprisingly, perhaps, we can see the major oil producers in the Middle East and also Angola falling by nearly 15% their revenues. What's the impact of that going to be? Is that we think about social unrest?
Well, I mean, that's obviously a very striking decline because oil accounts in some cases for 90% of government revenues.
Right.
However, conservative management of the oil industry means that the break-even rate for public finances is generally below $85.
Right. So they should be relatively okay.
They'll be okay. They'll still run a small surface, albeit much smaller than previously, which means they'll be saving just at a lesser
rate. All right.
rate.
So moving down the chart, who do you think is actually going to be at risk from this fall?
Well, I mean, it's really the people in the middle of the chart. There's countries like Russia and Venezuela and Mexico, whereby the break-even rate of oil is pretty high. It's over 100, probably 120 in some cases.
Right, and you see it going down to what price?
About 85 next year,
so
and remaining at that level.
And Russia is budgeting it well above that, isn't it?
Sure, about 120 we calculate.
Right, okay. Now what surprised me was the very small impact that you predict on countries like Brazil and Indonesia, which are seen as being heavily reliant on, or their growth being driven by commodities. Countries like Chile and Peru, hugely dependent on copper in Chile's case.
Sure.
Small impact on government revenues. Do you see any other feed through into asset prices?
Sure. I mean, with the first part of the question, tax bases are relatively wider in Asia and Latin America, which means that there are more non-commodity revenues for the government. They'll still be hit. I mean, these are substantial falls, but nothing to the degree of the Middle East.
And how will it feed through into, do you see impact on the currencies?
Sure. I mean, the wider impact will be through the terms of trade for these countries. So lower commodity prices means you can support a lower level of imports and therefore domestic demand.
Right.
There's also traditionally a link in countries such as Brazil between commodity prices, capital flows, and therefore the exchange rate and equities.
Okay, David, thank you very much indeed. As so often in emerging markets, then a question of looking quite closely at individual situations rather than getting swallowed up by the broad picture.